Hi, this is Michael Yardney. In my newsletter last issue, when I predicted that median house prices will be well over $1 million, that created quite a stir. It actually gave me lots of publicity in the media with news interviews around Australia, as well as many people emailing me saying it just can't happen because of affordability. Now, there's so much misinformation about the topic of housing affordability that I felt I must address this in my property update today. Now, there's nothing new about this debate. Housing affordability has been a hot topic for quite a few years, and everyone seems to have an opinion about it, and I regularly hear experts giving their opinions on how to solve the problem. But let's be honest, while many people feel that house prices may be a bit too high, and the type of price growth that we've enjoyed over the last decade or two could be unsustainable, I feel that most of us also have this secret enjoyment of hearing how house prices keep rising. Now, I know most of us are genuinely sympathetic for the average first home buyer struggling to get into their first property. But we also take comfort in the fact that our home, our castle, is quietly increasing in value. And we sort of hope this continues on because it not only makes us feel wealthier, it actually makes us wealthier. But of course we keep hearing arguments, the counter-argument like, property prices can't keep going up because 20 years ago the median house price in capital cities was 3 to 4 times the average wage. And today you hear all these experts say the figure is more like 7 to 8 times the average wage. And they keep saying things like, well, this shows how expensive properties become. Now, this is an often quoted statistic, and it seems to counter my forecasts for property prices doubling, or I suggested in some cases even much more than doubling over the next decade. But the answer isn't really as simple as all that. Let me explain. 20 years or so ago, the traditional Australian household was a one-income family. Today, a much larger proportion of households have 1.5 or 2 incomes. And this means they've got more income to support household expenditure, including housing costs. Number 2, today the average Australian pays a much lower rate of tax than 20 years ago, which means they've got more take-home income, more disposable income, and a greater ability to pay off their home loans. Point number 3 is we're enjoying much lower real, by that I mean inflation-adjusted interest rates, than we did in the late 80s and early 90s. And that means that our capacity of households to borrow more for housing has increased. Another point you've got to consider is that increased competition between the banking sector over the last couple of decades has made access to housing finance so much easier for all of us. Now, I was recently reading a report by Christopher Joey, who's the director of Riskmark International. You see, he gave a presentation at the Melbourne Institute just back in November last year, and he argued that Australian housing was not too expensive. In fact, he pointed out that over the last 20 years, Australian house price growth was in line with the median house price growth of our peer countries, places similar to us. He also explained that there was no evidence of unusually high growth in Australian housing costs or our house price to income ratios compared with many other peer countries. In fact, many countries had significantly higher growth. And in his long report, he concluded that Australian housing affordability is better than our long-term averages since 1980. And that current mortgage repayments as a share of disposable income are better than average. Now, I bet some of you are saying, look what happened to all those overseas countries? Their property markets collapsed and so will ours. The problem is absolute comparisons between one country and another really doesn't work because of the differences. Well, let's look at a couple of differences. The international differences in legal and tax treatment of houses. For example, in the United States, you can claim interest on your home loan. When you look at one country to the other, home ownership rates change. They're much proportionately higher in Australia. Remember, close to 70% of Australians own their own home. Another difference between one country and the other are urban densities. Look, by that I mean in Australia, 60% of our population live in our 5 biggest cities, compared to overseas where they're spread out a lot more, aren't they? And this proportion is going to increase in Australia. Another difference is Australia is currently experiencing a population boom. So our population growth rate is so different from overseas countries, and that's creating an enormous upward pressure on our home prices. And another thing that differentiates us in Australia from overseas is the distribution of income. In Australia, there's not as big a gap between the wealthy, the average Australian, and the poor as there is in other countries. So as you've heard me say before, there's always going to be affordable housing. You just have to go to the outer suburbs or regional Australia or rural Australia. The problem is, most of us just don't want to live there. So to me anyway, the conclusion is inescapable. We're heading for another property boom where those who own the right property will make a fortune. But again, as you've heard me often say, not all properties are going to increase in value in the same way. This year, in 2010, we're heading for a three-tier market as affordability and interest rate increases will affect some Australians more than others. You see, I believe those who own properties in the more affluent suburbs of our capital cities, they're going to have much more strong capital growth and they're going to be sitting on a heap of equity and they're really not going to be worried about affordability. These inner and middle ring suburbs are likely to keep performing well again over the next couple of years. These suburbs near the city and the water will become even more expensive and they're going to strongly outperform the averages as owner-occupiers and astute investors chase those small number of properties coming onto the market in those locations. The problem is, as more and more home buyers and investors find themselves priced out of those inner ring suburbs, they're going to start moving out to more affordable suburbs in neighbouring middle ring suburbs. So these are also going to increase in value, but maybe not to the same extent as the inner suburbs. However, the outer suburbs are usually where homeowners are more interest rate sensitive. Already some are currently struggling to meet their mortgages, and as interest rates increase over the next year or two, property values in these suburbs are likely to languish. Now, I'm going to be explaining my forecasts for the next property cycle and how you can take advantage of these new emerging trends at the only round of seminars I'm going to be conducting at least till well into the second half of this year. So if you want to ride the next property wave and take advantage of the opportunities the next property cycle is going to offer, please click on the link down below to find out about these seminars I'm going to be conducting with property tax experts Ed Chan and Ken Race and finance strategist Rolf Schaefer. Now, already everyone's talking about the next property boom, and I'd really like you to make the most of it. So please join us at our Catch the Next Property Wave seminar. So click on the link below and find out about these seminars and join us in Brisbane, Sydney, Melbourne and Perth. Now, if you want to keep up to date with property in between these regular fortnightly property updates, please follow me on Twitter when you can get my daily tweets. I'm Michael Yardney and I look forward to catching up with you at my Catch the Next Property Wave seminars in March around Australia.